Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing in crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and are looking for smart money management options, then we are fortunate to have found each other. There's an argument roaming around that no debt is good debt. However, borrowing money and getting into debt is the only option for many people to buy critical big-ticket things like a vehicle or home. Well, before taking any debt, imagine if a credit card or a car loan will assist you in achieving your financial goals or make your goals more challenging. The sort of debt you choose and the cost of that debt can make a major difference, or in other words, draws a line between good and bad debt. You may have heard that debt is divided into good and bad debt. Money due for items that might boost income or develop wealth over time, such as mortgages, education loans, or company loans, is referred to as good debt. Consumer debts and credit cards are examples of bad debt since they don't help you to improve your financial situation. Well, these statements are oversimplified. The differences between good and bad debt are subtle. That's why it is very important to understand these debts and the rules of this game. And in today's video, we are going to discuss both of them in detail. Continue watching the video until the end so you can get all the insights about the topic. What is a good debt? Saddled with debt. When you think of debt, negative terms like these may spring to mind first. Good debt is low-interest debt that assists you in growing your income. But taking more debt than your needs, irrespective of the potential it offers, can quickly turn into bad debt. A famous quote, "It takes money to earn money," is often applied to good debt. Debt that improves your life is good. Good debt helps you earn money and increases your net worth. How can a debt be good? Going into debt for non-essential purchases, such as an expensive car or a luxury meal, is horrible. However, you may require outstanding debt to fulfill specific life objectives. Few of us, for example, could afford a house without a mortgage or a six-figure college degree without student loans. To be sure, every investment involves some level of risk. However, in general, good debt may be anticipated to generate a positive return on investment. Let's discuss some of the good debt-incurring items. Own home. On the domestic point, the most basic is frequently taking out a mortgage to buy a property, living in it for several decades, and then selling it for a profit. Meanwhile, you enjoy the freedom of owning your home and a range of tax benefits that renters do not. You can also rent out residential real estate to generate income. Commercial real estate may eventually provide financial rewards if done effectively. Education. Borrowing money to acquire education can also be classified as positive debt. A technical or college degree can generally pay automatically within a few years after joining the employment. But it is also important to understand that degrees are always the same, so it is essential to assess all the future possibilities for any field of education that appeals to you. Taking a loan for business. The more enterprises a person has, the more money they can make. The business has a favorable relationship with the capacity to improve the economy. Better business people are more likely to employ a large number of people. Taking a loan to make a business is also a good debt. Being an employer may be financially as well as psychologically gratifying. Starting your own business is loaded with peril. Well, most businesses fail. However, there is a high chance of success if you select a sector that interests you and you like to work in. Now, let's discuss some examples of good debt. Student loan. A student loan is intended to assist students in paying for post-secondary education expenditures. The student loan market is growing faster than any other industry. The $1.6 trillion in student loan debt carried by Americans ranks second in the extent of the country's consumer debt. It is critical to understand the many sorts of loans available to you. If you apply for financial help, your school will undoubtedly include student loans as part of your package. Mortgage. A mortgage is a gateway to home ownership, and it is likely the most important financial choice you will make. A mortgage is a sort of loan granted by a bank or a mortgage lender that allows a person to buy a home or property. Mortgage debt has always been seen as one of the most secure types of good debt. You can obtain loans to pay the total cost of a property. You must repay the loan in installments. The residence acquired serves as collateral for the money borrowed. There are two types of mortgage. The first is the fixed-rate mortgage, and the second is the adjustable-rate mortgage. Business loans. If you want to establish a business or want to grow your current business, you are most likely looking for money to reach your goals. A business loan is borrowed money that a company uses to meet expenses that it cannot afford on its own. Entrepreneurs may get their firms up and running with the help of small business loans. Loans are not given out for free. Lenders charge interest on loans to cover the cost of borrowing money. Enjoying till now? Please hit the like button, share and comment, and yes, keep watching. What is a bad debt? These are the debts that can significantly disrupt your financial condition. It is not difficult to identify bad debt. If you borrow to purchase a depreciating asset, it is often a bad debt. It means it's bad debt if it loses value the minute you assume ownership. If you can't afford them in cash, you might consider settling for off-brand clothing, a lightly used automobile, and a 54-inch television. Sometimes these debts are in the category of good debts, but they go wrong. A common example of this debt is credit cards. It doesn't matter if you acquire a credit card with higher interest and pay your debt every month. But if you are not able to pay it off and this high interest accumulates, it can be a difficult scenario for you. Let's have a look at some examples of bad debts. Credit card. Credit card debt is an extravagant type of debt to incur. A solid rule of thumb is to avoid getting into debt to buy items that will not be appreciated. It is not utilized to purchase things that are appreciated. You might use it to depreciate purchases. A credit card is considered a bad debt due to the high interest rates and low minimum payments, and the fact that it is not used to purchase appreciating assets. Use your credit cards for the points and other perks, but make sure to pay your debt each month. Clothes and other consumables. Well, clothing's total worth is mostly less than half of what people spend on them. You require clothing, furniture, food, and a variety of other basics, but using a credit card with a higher interest rate to purchase them is not a prudent utilization of debt. Therefore, if you want to avoid trouble, it is recommended to pay your returns every month so you can avoid all the costs of interest. Alternatively, you might try paying with cash. Car loans. Borrowing money to finance a deteriorating item is nearly always a terrible idea. The average automobile loses roughly 25% of its worth in the first year and about 50% of its value in the first 3 years. The typical auto loan in the United States currently lasts over 7 years. The longer the loan, the more interest you pay and the more likely you are to be upside down on your loan, which means you owe more than the car is worth. Having vehicle loans is also a credit risk. The fact is that vehicle loans are destroying wealth. That's a formula for insolvency. Payday loans. Traditional lenders' loans sometimes have minimum sums in the thousands of dollars and are repaid over months or years. They may also have stringent credit and income requirements. Payday loans are being phased out in favor of unsecured cash loans for little amounts of money. They have exorbitant interest rates and curtailed repayment terms. The borrowed money, plus interest, is due when the borrower's next paycheck arrives in 2 to 4 weeks. Unlike bank loans and credit card accounts, payday loans do not need extensive verification. Because they deal with high-risk clients, payday lenders charge hefty interest rates. Most states now have control over the interest rates on these loans, and lenders are exiting such markets. Many borrowers are not able to repay their loans within the standard 2-week payback term. They must borrow or pay another round of fees when it comes due, further plunging them into debt. Exceptions. Not all debt can be classified as either good or bad. This is identified by your financial condition or by other considerations. Particular debt can be good for some people, but can be bad for others. Borrowing to invest. Borrowing money for investment makes sense only when the loan's return on investment is high and the investment's risk level is low. An investor should avoid investing in a loan in a hazardous vehicle such as the stock market or derivatives. This type of borrowing is not appropriate for novice investors. Different ways to borrow for investing. The 4 methods for borrowing to invest are listed below. 1. Borrow against your home equity. 2. Short sell stocks. 3. Buy on margin. 4. Take out a loan or line of credit. Obtaining a loan to pay off debt. Customers currently in debt may benefit by obtaining a consolidated loan from a bank or any other lender. Debt consolidation is the process of getting a new loan to pay off previous obligations. Multiple obligations are consolidated into a single, more considerable liability, such as a loan with more advantageous terms for repayment. These consolidated loans mostly allow lower interest rates than credit cards, which will help you to pay your previous returns but also save money. Choosing to take on extra debt is a personal one that necessitates some research to evaluate whether or not you'll get more out of it than you put in. You safeguard your future self by constantly being aware of the purpose of the debt you're taking on. The appropriate amount of healthy debt can improve your ability to save for the future and finance the things you want in your life. You'll be able to measure better whether this additional loan makes sense for you once you've added in the various things and weighed those numbers against the worth of your asset. Well, that's pretty much it. Hope you found this video helpful. Don't forget to share your thoughts and ask your questions in the comment section down below. Thank you so much for watching. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.